Welcome to another real estate industry update. I'm your host, Daniel Roccanti. Today we have the pleasure of hosting Jeff Newman, who will enlighten us on how life insurance can serve as a valuable tool for real estate investors looking to build wealth.
Yeah.
Jeff is a director at Jones Lowry, specializing in tax efficient life insurance design and management strategies to help maximize wealth accumulation and wealth transfer for high net worth families. Jeff, thank you for being here today. Could you start off by telling us a little bit about yourself?
Absolutely, Daniel. And thank you to the James Moore team for having me. We have worked together and enjoyed it, both for real estate families, construction families, a lot of development companies. Very simply, what we have done in Palm Beach for 40 years and I've been doing in North Florida now for the better part of a decade is we say if you don't have an opportunity to take care of your family or take care of your business the way you'd like to, we step in and make sure that it's taken care of for you. And there's a lot of tax efficient strategies that we implement. There's a lot of strategies that we implement for fantastic families where the most important thing is using up as little of their gift exemptions as possible. Depending on what stage of life you and your company are at, we like to advocate on your side and present the most efficient way of handling it.
Thanks, Jeff. Well, I'm really excited to have you here today. Life insurance is just one of those topics that is very complicated, and Jeff makes it just sound so easy. So let's start off with some of the easy stuff. So, Jeff, why don't you tell us a little bit about the different types of life insurance there is?
Sure. One of the greatest fallacies that the career agencies have pulled off is convincing everyone that there's two types of life insurance, a term policy over here and a whole life policy over here. And while that is slightly true, it's mostly term insurance, which is generally known as renting a death benefit, where we're going to buy a whole lot of death benefit and it's only going to be applicable for a certain amount of time. Generally, you buy the term that's going to be a level premium that entire time, and permanent life insurance, of which whole life is one of the first contracts, but there are many different flavors of permanent life insurance that can grow cash value within policy and generally guarantee a death benefit for you or your company.
Yeah, you're right. Permanent life insurance is really where it gets complicated. It combines two things, like the death benefit and the saving and investing elements. So that just creates a very complex situation, and it can be a very valuable tool if you know how to use it correctly for your situation. I'm going to go over the benefits of kind of the tax benefits of permanent life insurance. So there's about five main benefits when it comes to permanent life insurance. First is the cash deferred cash value growth. So basically, this is just the cash value component of permanent life insurance. It grows on a tax deferred basis. You don't pay any taxes on the gains as long as it remains within the policy. The big one that a lot of people know about is the tax-free death benefit. This is the same as term. Basically, the death benefit is paid out to the beneficiaries and it's generally tax-free. Okay. This just allows people to basically get the cash, the financing they need without the burden of having to deal with income tax on the payout. Other big tax benefits is the tax-free policy loans. So you can borrow against your cash value of your permanent life insurance policy without incurring taxes on the loans. Okay. Loans is usually not considered income. So you can use that to your advantage and do a loan against it. There's also tax advantage withdrawals. So if you don't want to do a loan, but you can actually withdraw your cash value, right? And it works on a FIFO basis, which is first in, first out. And that just means you can withdraw the premiums that you've paid into your cash policy tax-free first before you get into your gains. Usually only your gains above the paid premiums are subject to tax. And then the last usually big benefit is no required minimum distributions. Most retirement plans have some form of retired minimum distributions. Just means that once you hit a certain age, you have to start taking some kind of money out, which is creating a taxable event. Life insurance does not have this. So you can leave the money in or you can withdraw it, and you have many different options to do it tax-free.
So let's tackle these one by one, and let's hit the Wayback Machine all the way back to 1984. And I'm going to put on my salesman hat, and Daniel, you get to be the client. And guess what, Daniel? We're going to underwrite you for $100,000 of life insurance. And we'll take a look at your medical records, and maybe we'll draw some labs from you, and eventually you'll get an offer from the insurance carrier, at which point I come to you and say, Daniel, write a check for $1 million. And you say, excuse me, I thought I was getting underwritten for $100,000. Why am I writing you a check for $1 million? I said, because overnight, that money is going to be completely unavailable to creditors, and it's going to grow entirely tax-free. Oh, by the way, you're going to have access to this money nearly on demand anytime you need it. And you say, oh man, that's a great idea. Hold on, let me go get my checkbook. Well, guess who didn't think that was a great idea? The IRS. So they implemented a rule back in 1984 for IRC Rule 7702, which stipulates you can only put so much money in so quickly to a policy. Eventually, they might say that, you know what? We don't think that that qualifies as life insurance anymore. Putting $1 million overnight into a $100,000 policy, we're going to consider that a modified endowment contract. Why do I go through this explanation? Because that's when you go from all these tax deferred gains, all these tax-free gains within your cash value to, guess what? It's like a regular brokerage account again. You've lost your tax advantages. So anytime you hear this modified endowment contract or MEC rule, that's what they're stipulating. Now in 2021, the insurance carriers marched up to Washington with the lobbyists, and they're very powerful up there, and said, listen, you guys are still implementing the rule as if it was 1984 when the interest rates were in the teens. We're in a 0% interest rate policy. And right now, the bonds that we're buying within our general account, our general investment grade corporate bonds, those are paying far less than the 5 and 6% dividends that we've paid our policyholders for years and years. They said, what do you want us to do about it? They said, please relax the rules. The rules still stipulate a interest premium that must go towards the death benefit rather than the cash value, as though the ongoing interest rates are still in the teens. So they relaxed the rules to the ongoing interest rates of the day. What does this all mean for policy owners? This means that when you buy a $1 million permanent cash value policy, now I can get a lot more money into it as an advisor without underwriting you for a ton of life insurance. If you said, Jeff, you know, I'm already doing about 50 grand a year into my SEP. I'd like to do another 50 grand a year into a life insurance policy. That way I have money in 2 different buckets. So in retirement, maybe I'll pull, half of my income from a qualified plan and half from from the little amount I have in a Roth from when I earned less than that in a life insurance bucket where I don't have to report that on my 1040. I like the idea of kind of diversifying the buckets that I can pull from in retirement. Great. Well, if I underwrite you for $50,000 a year of annual premium, you might be able to get that into $1 million policy with a much lower cost of insurance than, just, 2020 or 2021, where you have to be underwritten for $3 or $4 million. This all means that the illustrations that come along with policies that are written now are all far more efficient. You're carrying a much lower cost of insurance. So life insurance for retirement planning, deferred comp ideas. Sometimes you'll hear about the Jim Harbaugh or Dabo Swinney plan, where you have different arrangements that an employer is paying into a life insurance plan for a retirement distribution for a key employee. All these ideas are coming to the forefront again because that IRS regulation was relaxed in 2021. So all the advantages that you've just discussed as far as cash value advantages, withdrawal to basis, no RMDs, and in tax-deferred growth really become a lot more attractive in the past few years.
I agree with you, Jeff. I've seen the rise of this on our side a lot. And I mean, Jeff, you just gave us so much information. I hope everyone was able to follow what Jeff just said. That was some of the most valuable information I've heard in a couple minutes, especially when it comes to life insurance. So I really appreciate that. So let's get into some meat and potatoes here, and let's go into some actual where this can really help. So for the first one is let's talk about estate planning. Okay.
Sure.
So a lot of high net worth families, they have significant real estate holdings or businesses. Okay. This can cause liquidity issues. All right. So basically you have someone, they pass away and they have all these assets that unfortunately there's no liquidity there. You got to sell them. You got to do something. So, but you have estate and inheritance tax. If you are a high net worth family, you might be above that threshold where you got to worry about estate and inheritance tax. Also, you got beneficiaries that are split on whether they want to keep the assets or they want cash. Some people might want the unliquidated asset like real estate and keep on to it, and the others are like, I don't want it. I just want cash now. Okay. So, how can life insurance be used as a good planning tool to solve this issue?
So, two parts on that. Number one, speak with a trust and estate attorney. We have some phenomenal firms up here in Jacksonville and North Florida that are actually used by individuals all over the country. The first thing is, if I own an asset, whether it is a privately held company, whether it's a piece of real estate, speak with the trust and estate attorney about what you're willing to do, what you're willing to give up as far as control. How do I have access to this? If the market goes crazy and somebody gives me an inappropriate number for it, what's that actually imply for my ability to access the funds, and really discuss a creative conversation with your trust and estate attorney. If you can't have a conversation like that, find a new attorney. We can recommend some great ones. But to the second point is, okay, fine. I have this wonderful asset. I have this family held company that's passed down for generation after generation. After my wife and I use, $26 million of exemption, the IRS is going to want $74 million to pass down something that has a $100 million valuation. Where are you going to come up with 40% on $74 million? That's sort of liquidity. And so we tell you that, a lot of you are walking around with assets on your balance sheet that belong to the US government. They're just letting you borrow them until the day you pass away. Nobody really likes hearing that, but we try to bring that to their attention because you can pay pennies on the dollar for the future delivery of dollars that your beneficiaries are going to need to keep these prized assets in the family. And so there's a lot of different, sad stories of celebrities and business professionals and really bright people that have made this mistake. But to your point, estate equalization is something that we see a lot of. And estate equalization is family held company. One of the brothers and sisters wants to be the next CEO. The other one wants to go and start a foundation somewhere, or just wants to be an executive in a completely different industry. How do we handle that as a family? We want to be equal in the part that one of us is going to take on the risk of running the business. The other one wants to leave and just wants to be treated fairly. So if we get a valuation today at $20 million and we buy a life insurance policy for the beneficiary of just the child that doesn't want any part of the business after the grantor passes, then we've effectively achieved that. Now, can there still be litigation down the road because the company is now worth $100 million and I got my $10 million policy? Of course. There's always going to be litigation between beneficiaries or greedy heirs. And the opposite can be true too. If the next generation CEO runs a business into the ground and his sister's sitting there with a $10 million tax-free check, guess what? He's going to be angry as well. So don't ever think that there's going to be a solution that's just going to make everybody happy every single time. We know too many succession plans that are worked out over decades and still fall on their face. But what we can do as planners and as advisors and as fiduciaries are give you options. A lot of your clients are excellent business professionals. If I can just spell out the risk reward, the premium, and the benefits, then they can make a decision all their own. But I really think it begins with a trust and estate attorney that advises you on what options you have, what control you lose if you choose each and every option.
And I have to agree with Jeff here. Always please talk to a great attorney. I'm a CPA, Jeff's CFP, but we're not attorneys. So we can advise here, and Jeff can absolutely, when it comes to life insurance, advise you super well. But when it comes to the legal process, there's always a legal aspect to this. Please talk to an attorney. I know Jeff and I both know a lot of attorneys that can help you in this situation. So we're talking about liquidity being a huge issue here. Basically, all of a sudden, you need all this cash, but you don't have it. I bet you there's some really good real life, experiences and stories that you can provide to us. Do you have one really good one?
So I grew up in South Florida. This is north to me. I like telling everyone that when they come down, they say, "Welcome to the South." Yeah, I grew up in Miami, and famously, the Joe Robbie family made their money. The Robbie family owned the Miami Dolphins and the stadium. And their estate plan called for some planning, but not nearly enough given the appreciation of the value of the stadium and the team. So what else could the family do except in a fire sale, sell the team? They had no asset that was going to come anywhere near what they were going to be able to get for the team. And it wasn't something that any professional could value at a low way or take a discount on. Everyone knew the value of the Miami Dolphins. So, quickly they had to come up with the money. And unfortunately, they had to fire sale the Miami Dolphins to Wayne Nzinga, and now it's been sold again. Unfortunately, we have another example of it in the news today that we see Lisa Marie Presley, daughter of Elvis Presley, had a $3.8 million lien against Graceland. And all of a sudden, we have her passing, and it could go up to foreclosure. And so it's unbelievable to think that some of the wealthiest families, with all the planning and everything that they've had, there's a difference between assets and liquidity. And every business owner knows it. But when you pass, you may be passing a significantly appreciated asset, shares, property, whatever, and really need that liquidity.
Yeah, these are great stories, because these are people that, most time when we look at them, these are some of the wealthiest people that we know, have huge achievements. Joe Robbie founded the Miami Dolphins. There was no plan executed that when they passed away, we want to keep the Miami Dolphins in the family. Maybe I don't have one of my beneficiaries who wants to run it directly, but we'd still like to be the owners of it, right? Same thing we were saying with Elvis, Graceland. You want to keep Graceland in the family, right? Now it could potentially be owned by someone not in Elvis's family, just because potentially there wasn't any good planning. Where life insurance could have came in here, created a liquidity in these instances, so that they would have been able to hold on to the assets, not have to sell them or give them away, so that they can pay basically taxes most of the time.
It's unfortunate, but true.
It is. So let's move on. We've talked about cash value a little bit and the benefits of that, but how can real estate investors utilize cash value to expand their real estate portfolio?
So what we see a lot of amongst real estate professionals is they get to a situation where they need money quickly, and they have a phenomenal deal on their hands. They have they have an asset, cost overruns, development issues, COVID, what have you, where all of a sudden there are hard money situations. Walt Disney actually came to this when he was creating Disneyland. And the ability overnight to create liquidity within your policy that you can pay back at your own, at a convenient time for yourself can be a huge lifesaver. Now, it takes a few years for these policies to get seasoned and have significant liquidity in there. As I described earlier, you can't just shove millions of dollars into a policy overnight and think it's going to be available to you without being underwritten for a huge block of life insurance. But in general, think of it this way. Say I've been underwritten for a $5 million policy. I have $1 million of cash value. And the time comes where I need, $600,000 to finish off a project, and then I'll be able to pay it back when I'm selling the project in 6 months and we close on something. That's the sort of situation that would be exceptional to be able to borrow from your cash value policy and pay it back at your own tenure. Like we said earlier, not a taxable event, liquidity on demand, a real nice bucket to choose from versus if you need to get underwritten for a HELOC. That could take months. That could be incredibly detrimental to your project. Hard money lenders, we know that can be exorbitant fees and something that really tanks the IRR of whatever project that you're interested in. So as you grow this policy and maybe you have cash value in there that you are earmarking for distribution in retirement, maybe you are growing it and earmarking it to move to a trust for estate needs in the future, but just not having to actually determine on the front end what you're going to use it for and always have kind of that liquidity in the background that's available to you can be very attractive to a number of real estate investors. You also hear this infinite banking concept. I won't get too far into it because we don't advocate it often, but the basic thesis behind it is a non-recourse loan. So if I have $1 million of cash value and I take a $600,000 loan against it, and my next dividend on the cash value is 5%, if I'm still getting a 5% dividend on the full million, not the net equity of 400,000, that's pretty attractive to someone that's going to have money out where I'm still getting enough of a dividend to pay off the loan interest of what's outstanding against me. Now this can get a little squirrely where you get a little over levered and the policy could get close to lapsing or a cash call. So we're very careful as we take these distributions and loans, and we make sure that we illustrate it properly and know every bit of the contract and the covenants that the carrier is going to ask about. But yeah, this can be a real godsend for someone that's a little bit over levered and has a little bit of a cost overrun, needs money in the short term in a significant amount.
I like what you mentioned here. So when you're dealing with a lot of real estate investors, there's most of them are asset rich, cash poor. Okay. So they kind of just in their nature already have liquidity issues because they're always buying new deals. And then real estate, it's all about timing. In the current market today, there's still plenty of real estate deals. It just it's not as good as it was a few years ago. So then when you find a good deal, you need to act on it ASAP. And like you said, you're going to have some issues if you're like, I don't have the liquidity to buy the asset. So now I either have to go out and try to get a loan, takes time. I have to find investors. Again, maybe that's eating into my equity on the deal, or I have to find investors. That takes time alone. So this is just another tool. Like you're saying, you can't necessarily fund it tomorrow, your entire cash value plan for these things. But this is something that if you have, now you have access to it. You can go out, get a tax-free loan on this policy, buy the real estate deal that came along that you couldn't pass up on, and basically reap the tax benefits of it on the life insurance side, but then get into your real estate deal ASAP before anyone else does. So you're just creating this tool that now a real estate investor can have that you didn't think you probably could even had it because you were like, I didn't see the benefits of life insurance. And you might even gotten the life insurance because of estate planning. Maybe that was the main reason why. But now you have this tool that you didn't even think about, didn't even know. You've been building up your cash value. After 10 years, you got a significant amount of money. It's like, well, now you have access to it, and you can continue expanding your real estate portfolio with cash-free loans from your life insurance policy.
Absolutely. And just remember, they're still underwriting the life of a human being. So people get very excited about this. You got to get through underwriting. If you're a healthy person, if you're not, into your 60s, it gets a little bit more difficult. But if you have significant time, and a lot of guys that have made a lot of money in North Florida in a short bit of time, they're healthy. They drive big trucks and they drive big boats. They really have been doing a great job taking care of themselves. They have a bright future ahead of themselves for their family. Get through underwriting now. We have so many different options for what we can convert it to later, how much we're going to choose to fund it or overfund it later, or minimum fund it, buy a guarantee. All those options come to you later. But if a diagnosis or an accident or a situation where, listen, you're working hard, you're running yourself kind of past the red line for too many years in a row, really building this thing to what your dream is going to be, get through underwriting now. Get some sort of, a convertible term policy or something significant done long before you ever need anything. And then you give your planners and your team options of how to use it later.
To learn more about James Moore & Company's real estate accounting and business solutions, go to jmco.com. And don't forget to subscribe to our Real Estate Industry Update series to receive updates when new videos are released. If you'd like to be a guest, or if there's a topic you'd like to see covered on a future episode, contact us through our website or email us at info@jmco.com. You can also follow us on social media for more news as the landscape of real estate continues to rapidly evolve.